Okay, for this video, I wanted to cover the IRS Form 8396. This is a mortgage interest credit form that is attached to your Form 1040 tax return. And so a taxpayer would include this form if they have an MCC approved loan and they made mortgage interest payments during the year, which they are allowed to take a federal tax credit for an applicable percentage of that mortgage interest paid during the year. So I've got a sample 8396 in front of us that's going along with the 1040 that we'll look at. And then I also have one slide here where we will look at some of the MCC program background and then the fact pattern that we'll use to complete the 8396. So what is the MCC program? Well, it was established in 84 and then it was amended again in 86, I believe. And effectively what this is doing here is it allows first-time home buyers to take a federal tax credit for a percentage of the mortgage interest they're paying during the year. So it's a government subsidy to try to help first-time home buyers with their mortgage payments. Now, the tax credit, very helpful to a lot of taxpayers because, one, it's a credit, not a deduction, right? Remember, tax credits are generally more favorable than deductions because a tax credit is a dollar-for-dollar offset of your federal tax liability, whereas a deduction is just a deduction in income, and then you compute your tax after. And it's particularly helpful here because a mortgage interest is an itemized tax deduction. And so a lot of taxpayers find themselves in a position where they don't even have enough itemized deductions to itemize. They're always just using the standard deduction. So that's why this mortgage interest credit can be quite useful in lowering your tax liability. Now, the qualification for the program vary. It's a state-by-state basis and even a county-by-county basis. So if you're looking to buy a home and you're trying to be, going down the path of getting into this program, you got to shop around a little bit to find an FHA approved lender. Or an HFA lender, that is, and then make sure that you meet the income requirements and the purchase price requirements, right? If you make too much money, you're not eligible, and if you buy a house that is too expensive, then you're not eligible either. So you have to make sure that you meet both requirements. Now, if you do qualify and you get the loan, you're going to get an MCC certificate. So it's a piece of paper that comes from the lender. And what it does is it outlines the amount of your loan, the interest rate you got, and then the MCC credit rate percentage, right? And so the credit rate percentage is the percentage that we're going to use to multiply by the mortgage interest, and that is effectively going to be your tax credit amount. And you're going to need all this information to complete the 8396 and compute the credit. Okay, so let's look at our example here. We have John. He lives in St. Pete, Florida, and he approaches a lender to buy a home. So he finds an HFA approved lender that can give him this MCC loan. Now John makes $35K a year, and he's buying a home for $170. So based on the Pinellas County standards, he's well within those limitations. So the house is $170. He's going to finance $155 at a rate of 3%. Now, the lender provides him the certificate, which has the lender name, an MCC number that's unique to John and his loan, the loan amount of $155, the interest rate of 3%, and then the MCC credit rate is 30%. And so this credit rate is established based on the loan amount. So based on his loan amount, he's going to get a 30% credit for the interest paid. So during the first year, he made mortgage payments totaling $7,841. And of that amount, $30,236 was principal and $4,606 was interest expense. And the mortgage interest expense here, $4,606, is going to be reported to him on a 1098, right? And then the IRS will get a copy of that as well. Okay, so let's jump back to the 8396. So 8396, it's relatively straightforward, right? John is going to put his name up here. The address here on line 2, he can leave blank because the address that's on page 1 of his Form 1040, that's the home, right? That's the home that he lives in. That's the one he used, or that's the one he bought with this MCC approved loan. Enter the name of the lender as noted on the mortgage certificate. the mortgage credit certificate number, and then the issuance date. Now, in part one, on line one, enter the amount of interest that was paid during the year, okay? And then line two, take the credit rate percentage directly off the MCC, right? So John's going to get a 30% credit rate. So line three is simply the 30% credit rate times the amount of interest paid during the year, right? And so the 1,382 is going to be the amount of credit that he is allowed to take on his tax return. Now, you know here on line 3, it says that if line 2 is 20% or less, just multiply through. If line 2 is more than 20, see the instructions. What they're asking you to do there is you can have a credit rate above 20, that's fine. It can go up to even 50%. But the amount of credit on line 3 is capped at $2,000. Okay, so that's what they're asking you to do here, is in the event that this amount is going to exceed 2,000, you can't enter more than 2K. In this case, it's not a problem because 30% times the 4606 is going to be 1,382. So we haven't hit the ceiling yet on the $2,000 credit limitation. Okay. Now lines 4, 5, and 6, what they're asking here is that, okay, in this case we have a first year mortgage amount, but if in the event that you have a credit that exceeds your tax liability, you're allowed to roll forward the excess to future tax years. So in this case, line 8, this is the amount of taxes owed on John's Form 1040. So let me jump up to page 2 so you can see what I'm talking about here. So if we look at page 2, line 16, the amount of tax that John owes before we look at any credits is $2,518. Okay, now that's the limitation because the mortgage interest credit is non-refundable, meaning you can't have it exceed your tax liability and get you more money. And so it works differently than, let's say, the child tax credit. Right. So what would happen here is, let's say instead of $2,518, John only owed $1,000. The excess $382 can be carried forward to future years. So we would complete part 2 down here to compute the mortgage interest credit carry forward to 2021. So if this was the second or third year we were completing this and we had some credit carry forwards from the prior year, we would input those amounts here. But in this case, we don't because it's a first year computation. And again, we're not capped out based on the tax liability. John's tax liability is $2,518, so that means he's going to be able to use the entire amount, $1,382, as a federal tax credit. So where does that amount flow through to? It flows through to Schedule 3 of the Form 1040. So line 6 here, other credits, and again, it's in part 1 is a non-refundable credit, meaning we can get a dollar for dollar offset, but you can't have this credit exceed your total tax liability. Otherwise, it just rolls forward. Right, so we've got 8396 checked there, 1382, and then ultimately that flows through to page 2 right here. So we have on line 20 amount from Schedule 3. There's the 1382 amount. So 2518 minus the 1382 means his adjusted tax liability is 1136. Okay, and so he had some federal withholding, so he's going to get a nice little refund there. So this is the real benefit here. Obviously, it's a dollar for dollar offset, but more importantly, this is where you can derive a tax benefit without even having to itemize your deductions. Right, so again, John, he doesn't have enough itemized deductions, so he takes the standard, but he still gets some type of tax benefit by taking the mortgage interest credit through the MCC program. Okay, so that covers it for this tutorial. I hope that was helpful. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.